We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. I'm Gabe Johansson, back in the SMI studio with Dane McKinney and Trevor Howard, just the three of us. We wanted to have a little, what are we having? We have 3/4 of the stack team here. We're going to have a meeting.
Our guest canceled, so we didn't come prepared. But we have a good we have a good idea for you, maybe.
Oh, okay. You want to share an idea?
Dane does, yes.
And allegedly our guest was
I thought you wanted to talk about SpaceX IPO.
That was my good idea.
No.
We
want to talk about real estate.
Can you still buy it? Or is it already out? Did it come out?
Can you still buy it?
Can anybody buy it?
I think so. Didn't it IPO a couple days ago?
I got a question for you. Your silver option thing you bought?
Yeah.
Was it an option to where it can go, like, can you lose more than the money you put in?
No. No.
Jaron was asking me about it.
Yeah. So
Why'd you do that?
Met a guy who's really smart and told him to.
Who told him? Your dad?
A guy who's really smart.
Oh, a guy.
Yeah.
It wasn't me.
No.
He said really smart.
Oh.
It was,
Yeah, it's true.
and I said Matt. I've been knowing Gabe. I've been knowing Gabe for a while.
All right.
The only way that you can lose infinite money is if you sell a put. Yeah.
And that's not what you did.
That's not what I did.
Okay.
No, I bought a call.
Gotcha.
I don't understand any of that. That's why I buy real estate, because I'm dumb.
Somebody's probably going to correct me on that. There's very few ways that you can. Usually, there's a stop loss on it.
We need an AI chatbot on Deal Junkies to like say they can click a button like, are these guys what these guys talking about really correct? I want to fact check.
We shouldn't have that.
Okay, yeah, it is. It is. So a call gives you the right to buy a stock at a certain price,
okay.
Right? And then a put gives you the right to sell the stock at a certain price,
okay.
to somebody.
Okay.
And so if that's, I'm pretty sure.
So then you watch the value and you make your decision based on where it goes?
But well, no. You have to guess where you think it's going. That's why it's risky. But the reason that a put can be infinite loss is because you're forced to buy it
at that price,
at whatever price it's at.
Even if
so
it drops.
if it goes, if it goes up
through the roof. I see. You got to pay way more for it.
If it costs 10 times
so you
more.
want it to be less.
So
when you buy
you
it.
never actually lose infinite money, but your losses, quote unquote, are infinite.
Kiyosaki says don't own any of that in paper. You should own physical gold and silver. What do you think of that?
Own physical gold and silver?
Yeah.
I mean, I think that's probably better for really rich people.
But then it's risky to park a lot of metal at your house or
I mean, it's like
safety deposit box or something.
I think that sometimes people that are that wealthy get so out of touch with reality, just in the sense that it's
there's a gold bar in my nightstand.
Somebody with $2,000 or 10 grand or even $100 grand saved, it's it doesn't matter. It doesn't matter if you have the physical asset versus you're trading it on Fidelity or you're trading it on Robinhood or whatever.
Well, you think about if things go to hell and you got to go actually use this metal to do something. Like if I've got $1 million gold bar sitting in my drawer, what? I got to go figure out how to chop it up and trade it somewhere. I mean, I don't know. It's not easily. It's not fungible.
Yeah,
would say.
It's definitely a store of value, but I don't think that it's easily transactable. Yeah.
I thought the coolest way to get gold and silver was via the form of jewelry, because then you get to wear it.
Oh, but you like diamonds. You're more of a blingy guy.
No, I don't know what I am.
You like to get fake silver and gold.
No, I like to overpay for my silver.
When we were in Mexico and the guy that was selling you your most recent chain, and you were asking him what the
little calculator
were.
out.
Well, no, he was asking him what the stones were. And he said silicon, but in Spanish, and so it sounded fancier. And it was it's the same word basically, but I was like, wait, isn't that just
what's
plastic?
silicon?
Oh, just like plastic.
Yeah. It's silicon.
Yeah.
Just look cool.
But he was weighing it. He had it out on a
Yeah, he
scale, and
was
he's like,
weighing
what does silver trade for right now? And Trevor's like, oh, I'm way overpaying for this
making up
chain.
numbers. Yeah.
But value of silver going through the roof. That's why I paid 3x for it.
So you're wearing your net worth. You're showing everybody.
$200.
Actually, from when you bought it, like a week later, it had gone up quite a bit.
So then I only
Good job.
overpaid for it by 2.5.
So who's smarter, Dane who buys puts on silver, or you who buy silver chains?
Trevor.
That provides me more joy. So.
Oh,
Well,
so-
actually, ask me next January, and then we'll make the decision.
All
Because
right.
my call doesn't have to get executed until then.
January.
Yeah.
Okay.
I have till January.
All right, let's
All right,
talk about
TBD.
real estate.
All right.
I thought you were going to bring me an idea.
Yeah.
Oh, yeah. Okay. So, for the people listening, to give a backstory to
Give
this
us some
idea.
framework.
Some framework to look at this through. So, Trevor and I prior were running Vesta, and Vesta was our real estate advising company. We had a brainchild, which was a very simple one. And it was, if Trevor could do this as an engineer, not knowing anybody or anything about real estate, and really kind of just be shooting at the wall, hoping he was going to cash flow on real estate at some point enough to retire, then we could probably teach other people how to do it. So we started telling people how to buy properties.
How to build and scale a real estate portfolio.
That's right. Sorry, I forgot our tagline: how to build and scale a real estate portfolio, which really just meant buy duplexes and triplexes and fourplexes, which is a good way to start building and scaling a real estate portfolio. Anyways, when we decided to stop doing that and we started doing Stack, we kind of like lost the vision of the avatar more so. It was also kind of funky because Stack has so many different ways to buy deals. So you have like 3 different
So for somebody who
avatars.
hasn't listened, tell them what's the difference between Stack and Vesta?
Yeah. So Stack is our investment company, not a means for like brokerage or transacting.
Mm-hmm.
The goal of Stack is to build our portfolios as a group and then do it with a number of different tools. And so we buy and build apartment
And bring
complexes.
partners and investors along with us.
Yeah. And
So now instead of like, oh, I'm going to show you how to go do it, this is more like, come do it with us.
let's do it together.
Okay.
Yeah.
Or done for you.
Or done for you. But that was the issue, is that it became like, you can invest with us, and then some deals we just buy by ourselves, and then other deals it's done for you, and then other deals it's like we can do a joint venture and you're going to help us a little bit in these ways. And so every deal we've bought has been different, really.
Broad spectrum.
Yeah, there hasn't been.
And all deals are different.
Yeah, and all deals are different. But I think we kind of realized that our avatar
Was unknown.
unknown, but we had like 3. It was like somebody who is a doctor, has high income, and is going to want to invest in real estate, but doesn't have the time for it and shouldn't really invest in real estate on their own. It doesn't make sense to. And then the other one was like a property owner who's sick of owning the properties and just kind of wants to stop having to manage, but doesn't want to pay taxes. And then the other one was like, I don't know, somebody who
20 million plus.
yeah, like high net worth. But anyways, what I think we recently figured out was that our avatar is still the Vesta avatar, because that's who we speak to the best. Trevor, he's good at finding these people, and he's been finding them for Stack though. And by that I mean, when we were talking to all the people for Vesta, it was how to build and scale a real estate portfolio, but it was all people who owned like 0 to 3, 4 rentals. And then our goal with that was that 10 years from now, all those people would know, like, and trust us. And
You'd
then we
be
would
doing
get to
deals.
play with their portfolio.
Yeah.
But then Trevor was like, skip that, because he's not patient. Let's just find all the people
That already
who
did
got
it.
created by somebody else's
10
Vesta.
years ago.
Yeah, let's find all those Vesta clients that somebody else made a long time ago.
Yeah.
And then let's use their portfolios, because there's so many people who like kind of, you get like excited and it works for a while, but then when your niche isn't working anymore, and we see this all the time where it's like somebody who, and one of the guys who I won't mention, but he's a local guy, and it's like everybody has these different metrics that they base it on. It's like, $100K a door, or like
What gets them excited?
A 6 cap, or what gets them excited.
Kind of an entry level buy box where it's
Yeah.
kind of like I don't really have
It just
a
worked
model.
on a deal.
Yeah.
I did a deal like this, so I
Yeah.
kind of like
And I
that.
really like
and
it.
so I just kind of stay in that lane.
But they don't know why it works.
Exactly, yeah.
And then sometimes when the market, like for example, from 2014 to like 2018, when the market is pretty steady, if those people had really good income at the time and they were investing it into real estate, they could do that same deal over and over. And so in their mind, that was like how they did deals.
Well, there weren't a lot of deals out there. But if you were hunting pretty hard, you could do some deals.
You could find stuff. And I'm not saying that was the best time, but there's time periods where the market doesn't drastically change. And so if you have a specific deal type that you like, even if it's not a great deal, quote unquote, you can buy a bunch of that same type of deal in a period of time.
This reminds me of Paul when Paul Curley, I picked him up as a client and I sat him down. He goes, okay, there's 2 rules. One is I don't want to use any of my own money. He back then he would say I'll put 10% down, but you got to go find me sell or carry. He said, but rule number 2 is I don't pay more than $50K a door. And so I started like for months I'm looking for deals and I came back to him and I'm like, Paul, the closest I can get is like, I mean, I did find him some under 50 back. Actually, I sold him one for like 25 a door, one for 40 a door. I mean, this is not that long ago. For me, it doesn't feel that long ago, like 10 plus years ago. But then I started bringing him deals and I'm like, hey, the closest I can get is like 55 a door. And he's like, oh, 55 a door.
Ew.
And I'm like, if you want to transact in this market, this is as good as it's going to get, but we're still going off of a per door type of a thing.
That's so funny.
And within like, the one deal was 55, the next deal was like 75, the next deal was like 100. You know, it just went boom, boom, boom.
Yeah.
And it was just like, well, if we want to do deals, you have to like, it's kind of the same thing. They call it sticker shock in the car business and other industries where it's like you bought your last car 10 years ago and it cost you 10 grand. You walk in and a new car is 20 grand. You're like, no way, I would never pay that much for a car. Like if you haven't bought a car in a while and you go look at how much they are, you'd get shocked. Same thing happens in real estate. You're like, well, I only paid 150 grand for my duplex. How could it be 400 grand today?
Yeah.
So your brain sort of does this. You get married to these. It's not a true model. It's not really a great way to identify a deal. It's just you remembered that you made money on that deal in the past, and you kind of get married up to it. And what happens is if you don't break away from that, you can just maybe never do deals again.
Yeah,
the price per door is funny too because you have such different unit sizes and types.
Yeah,
so like
there's deals at 100 a door that don't make any sense, and deals at 300 a door that do make sense. Yeah. But that's hard. I mean, and that's the weird thing about looking at listed properties too, is you'll go through, and like you're not underwriting each deal to go, is this a deal? Yeah. You're just skimming through it like you're reading through the newspaper, and you're like, oh, that doesn't look. Cap rate looks too low. The price per door looks like. Those are the kind of the initial tests. So then you have to train your brain to what am I actually looking for?
It's like rent per square foot and price per square foot. Like
I also think it comes down to like the vintage of the property, the size of the property, the location of the property, and if you could train your brain to just go like, everything that's for sale is on the market today. The problem I had when I first got started is I had to go find all the inventory because there wasn't any. Now, everything that's for sale is most likely listed. You can just go through them and just don't pay attention to the cap rates and the price or the price per door. Just go in and go like, that's an asset I'd like to put in my portfolio. Then dig in and try to back into it and figure out if you, and don't look at that price and go, I don't like it at that. If you don't like it at that price or that cap rate, that's what offers are for. And right now, a lot of people are afraid to write an offer, but you should. Why isn't anyone writing offers when there's motivated sellers? I mean, I see deals that are repricing right now at like, we just dropped the price $1 million. It's like, didn't anybody want to write on that for a few $100,000 less and see if there was a deal there? Like, it's like nobody writes. It sits there, and then it gets this huge price drop. And I just wonder.
Well, that's what Jay was talking about. Like, why now is the best time to buy? It's because he's like, if people liked the prices 4 years ago at 30% higher, it's like we're in an insane time period of like it's the same thing with every asset type. When it goes down, no one wants to buy it. Everyone buys it. Everyone wants
when
to buy
real estate goes back up 30%, we're gonna have buyers galore.
That's a great asset to own.
I heard it went up 30%. I want to own it. It's like you do, but you wanted to own it before it went up 30%, not after.
No, and I want to really quick. The funny thing about the price per door, because I want to see if this will work, but if there is a new construction asset in the state of Oregon trading at $160K a door, what do you think? Like, where is it? What is it? But I don't
care where it is. Buy it.
but that's
what I think.
That's what you'd think. But then it's like, those are micro units in downtown Portland.
Ooh,
like that's what it is. Like there's stuff that's listed right now that's that. But it's like, average unit 400 square feet
or 200 square feet.
Yeah, or like 300 square feet. Like and those are bedrooms.
I'm part of the first syndication I got involved in is out of LA. Really smart group, and we were doing. I mean, my partner who runs that is like, he got a perfect score on his SATs. One of the most brilliant people I've ever met. He helped Microsoft develop their most recent version of Excel. I mean, I don't even know how to work a spreadsheet. This guy like designs the program that runs the spreadsheet.
Yeah.
Like smart. And he could build models and like, he'd call me and what about this deal? And I'd underwrite it in 30 seconds. And he'd call me 2 days later and tell me, that's correct.
Yeah.
Type of a thing. But he would do all of the work and run it through all of the models. And what was funny was we were trying to figure out how to get through the process faster to identify and really kind of develop, just kind of at first blush, how do you go through everything that's out there? Because there's a big pile of deals to go through. Which one do we start with? Mm-hmm. What he ended up with was gross rent multiplier. Mm-hmm. And it came down to like, if he could run through the deals on a multiplier, it wouldn't necessarily tell you if it's a deal or not a deal, but it could at least like it could filter out to the ones where it's like, okay, well, here's the top 10% on gross rent multiplier. Let's start with those deals first. There.
Isn't that funny? Because that's just like a byproduct or another way to look at the 1% rule. Mm-hmm. Like it's just the same.
Which everybody said was stupid. They're like, you can't buy a deal on the 1% rule.
Yeah.
So tell it for the listeners that don't know, what is the 1% rule?
Trevor would know better than me. I think I butcher it. I know what it is.
It's like if the rents are $1,200, you want to pay $120,000 a door or less, right?
Yeah,
I mean, roughly. That's not a 1%, but that's close.
Yeah, that's 1%.
I think that's
exactly
1%.
Is that exactly?
Yeah.
You just take the monthly rent divided by the unit
but
price.
there's 12 months in a year, not 10.
I know, that's why I get weird.
The monthly
price. But the 12-month would be the gross rent
Wouldn't you look at the yearly? Yearly you do the gross rent multiplier. Okay. Yeah. But that's the... So if you go, if it's 12... Because like when Mike goes, we're buying this deal at about $130 a door and it's got $1,400 rents, we all go, that's a deal.
That's a good deal.
Yeah. Just because you do that quick math in your head.
Yeah. But to get back to the thought that we were talking about, the avatars. So because of that... I decided that I think for the 15th time, I think we need to consider starting a fund.
Oh, I think we already said that.
I know. No, I know. We've said it a lot of times. I know, and it keeps getting shot down. But the reason being,
we said we needed to start a fund, but we didn't have a goal of the fund, an avatar of it. It's just like, let's start a fund.
Yeah.
It's like, what does that mean?
What are we going out to buy?
Mark had a goal, and his was way off of what Stack's goal is as a company, but he loves doing fun stuff. And so he wanted to start a debt fund. But then we've kind of talked about starting like other types of funds. Mm-hmm. And then I think I came to the realization that we need to start a fund that the avatar is all of those people who want to trade out of houses, duplexes, triplexes, and fourplexes into larger commercial real estate, multifamily.
You're catching up with Logan now.
And so I think we need to sit down with Logan. Yeah.
That's what we already do.
No, I know, but we don't do it.
Oh, okay.
Yeah.
You know what's interesting? I had 2 meetings this week, and both high earners. They're making a lot of money, and they have a lot of tax exposure. They're not real estate professionals. And they were coming to me, and it's interesting because a lot of people want to buy real estate for cash flow or appreciation or whatever, but they were coming to me looking for depreciation.
Yeah.
That's a very interesting one, especially when you're not. So we went down the whole kind of trail of how do you become a real estate professional, or can your spouse become a real estate professional, and what are all the rules around that? And really, it's something that people are not taking enough advantage of. Like, especially if you're already a broker or a real estate professional in the industry and you're not owning real estate. It's one of the things we do at SMI is we promote all of our brokers to own real estate, because it's like, why wouldn't you build a retirement and generational wealth and save yourself all of these taxes? It's like, I could be using all the money I was spending on taxes for down payments on buildings, basically.
Yeah.
And it's like a tax hack. It almost looks on paper like it shouldn't be legal, and nobody's doing it. I mean, people are doing it, but it's like, I was probably in the business over 10 years before Logan's the one that brought it up to me, and he started explaining it to me. I'm like, are you kidding me? Now I meet with our CPA, Adam, our CFO of our fund, and he's like, I'm like, what? Because he does all the bonus depreciation, cost seg studies and all the stuff. And I'm like, well, what happens? I'm bringing all that depreciation forward. And then next year I plan on making more money. What am I going to do? And he's like, you got to keep buying more buildings. So now you get yourself into a new cycle where it's like, I'm not just out like, oh, I like that deal and I want to have fun and I want to make cash flow and I want to build all this equity. It's like, oh, I need to buy buildings if I'm going to have businesses that generate income. But I think that there is an avatar out there for folks that make good money and they would rather put their money into real estate instead of writing a check to Uncle Sam.
Well, that's like the last 4 people we've been dealing with and we're trying to do deals with are all the same type of person. They're 50 to 60 years old.
Some of them younger than that.
Yeah. And they have assets. They have really low return on equity. Like they've just been sitting on them. Their depreciation schedules are running out. Like, and they don't know how to do like what is a good deal, why.
Well, and the problem I ran into in doing this thought experiment was I was like, the problem you have is you need to go out, if you're going to build buildings or buy buildings, like you need to buy and build pretty big buildings.
Yeah.
And like they're excited about, because, I want, like they're thinking maybe I pick up a 4-plex or I pick up a 10-plex or something. It's like, no. Like you need a much bigger depreciation schedule. You need to get it.
Yeah.
So you basically have to get into a deal that's bigger than where your expertise lies. Yeah. And so then where is the answer to that? And that's kind of where we came to in both conversations is it's like, hey, we can solve your problem by going out and doing a deal. We can JV or you can come in as an LP or whatever we need to do. And we can go, well, I guess LP, they wouldn't get the depreciation, but.
Well, no, they can.
Some of it, right?
Technically, they can get all of it as long as they're a real estate professional.
Oh,
yeah.
Okay.
And I've heard very, very mixed like, I guess, information on that specifically.
I think you could ask 5 CPAs and get 5 different answers.
I've heard from CPAs that have said, no, if they're an LP, they totally can. If they're a real estate professional.
There's so much gray area in the tax code that I think that it depends on where your CPA lands on like how conservative or creative they might be. And most of the time your CPA is guiding you to not get an audit, like what's going to trigger an audit or what's going to fail an audit. And so every CPA is willing to take risk up to a certain point. So if you have a very conservative CPA, they might tell you like, no, you can't write off anything. You have somebody that's more aggressive, they might tell you can write off the whole thing. So flesh out your idea here for me, like to build a fund.
Well, I think we would end up really, really wanting to sit down with Logan, obviously. And the idea with the issue right now with doing it as the SMI fund is the parameters for purchases within the SMI fund. And Logan would recognize that because there's certain deals that he's doing with us outside of the fund because it doesn't fit the fund's buy box, and that's good. Like that's a good thing.
We've given ourselves pretty tight parameters within the fund, in terms of debt coverage and all the other stuff.
Totally,
and how much of the portfolio has to generate income and so on. Like we can't just run out and start 3 development projects.
And it's relatively low levered. Like
it's all meant to offer a bond-like yield and be very, very. It's very, very safe. Like it doesn't act at all like our personal portfolios where we take a lot more risk.
No, and just the risk profile of a bond
it's much
portfolio,
lower.
but a much higher return than a bond portfolio.
Higher.
Yeah. And so, and you can kind of cater to that. And I think that's something that people might miss is like, well, if the risk is the same as a bond portfolio, then the return should be. And it's like, well, no, because you're creating the spread through effort and being in the market. And Logan's doing that. And so that's why it's a better offering. And it's like, well, yeah, it has to be, if it's the same risk, it has to be a better return than a bond because you can't, nobody will believe that it's the same risk because they trust the government more than they trust you.
Well, Jay Scott told us that multifamily went down, I think he said when I was listening, 25 to 35% or something like that.
And then like 45 in some markets.
And 45 in some markets over the last couple of years.
Yeah.
And the same time, the SMI Legacy Fund has gone up 26% in share value.
Yeah.
So we've gone the opposite direction.
In per share value?
In per share value.
Wow.
Yeah.
Well, I mean, you're able to see that even with the deals we're doing. Like we're able to do deals right now in that market cycle.
Yep.
Well, and ours are better than a 26% return, but ours are riskier.
Much.
And that's the, I mean, well, let's just say much. But no,
but we're risking a lot more of our own money in there and stuff. Yeah.
But all that to say, I don't think that we want to go reinvent the wheel by any means, but I think that it's worth sitting down and saying, hey, how do we make this a repeatable process instead of just doing one-offs every time?
Thinking about the end user of this, like what would appeal to them if we had a fund versus the way we're doing it now?
So I think that the guys that Logan is targeting are much more, and frankly, part of it would be a conversation of how we work like symbiotically, because we would end up running into both types of avatars. But in my mind, the people that Logan is targeting and who it appeals to the most are the people who really need the cash flow, just want to have better basis, and they don't get the increase in basis, but it kind of resets as you acquire more properties. So you get
they pick up new depreciation along the way.
Depreciation
they don't get to increase, because you basically, when they contribute a property, you're set at their basis.
They're set at their basis, but as they purchase new properties, they get to add.
They get to add to it.
Yeah. And so that avatar is somebody in my mind who's really looking for an exit for their portfolio, similar to a DST or like a REIT or just something that's
we're a competitor to a DST.
That's who you're competing with.
It's your last trade kind of a thing.
And so in my mind, the other fund that we would be talking about is something that's much more similar to like a value add fund of like a syndication.
Happens all the time.
A multiple asset.
We're going to identify this type of asset in this market, and here's the metrics we're looking for.
The same deals we're doing now.
And you're going to raise $100 million or $1 billion or whatever you're going to do, and we're going to go out and chase those deals.
Yeah.
I've never done that type of a fund, but then my question is, are you providing a return like as they deposit their money in? Are you getting commitments and saying, okay, we've raised $1 billion and let's go do it? Because people are doing this all over the place.
Yeah. So the main difference between this and those funds, which is something that we haven't committed to doing, is that those funds are raising capital, and the ones that are getting $1 billion are typically getting it from
family office, stock market,
pension,
people.
Private equity, sovereign wealth. Like they're getting it from the $1 billion funds have like 20 investors. It's not a large number of investors.
And it's not, it's underneath it all is it's a lot of people's money.
Totally.
But it's that manager's managing for 300 clients and decides to put $200 million into that fund.
Yeah. And I guess the way that I'm thinking about it is we don't have the vehicle for either of those things, but we very much have the vehicle to say we can find all of the people who have portfolios that want to do quote unquote 1031 or that would want to do, it's like, no, I want to do value add deals and I want to do, but then we eliminate the timing risk. And so you start another 721, which is not how any of these funds are set up, but you're starting another 721 fund that has a much different risk profile than the SMI fund. And so the return profile is much better too, but it allows you to do all of the deal types that you want to do.
They call it an UPREIT.
Yeah. And then and then the people that are excited about kind of growing a portfolio still get to see the value add and development and ground up type returns, as opposed to, stabilized Class A multifamily.
Yeah, what's funny is going back, like if I contrast Paul Curley to Logan DeVos, Paul Curley would say, okay, let's just go out and get everybody to sign their real estate over to us, and we'll just find a way to do it with as little money out of our pocket as possible. Logan would say the exact same thing. Yeah. Let's get everybody to sign their real estate over to us. The difference being, instead of using debt, you're using equity, and you're bringing on partners, and you have a higher a higher fiduciary responsibility and all that, because they're not a lender. Now they're a partner, or they're an investor. But to say, like, rather than us going out and banging our head against the wall all the time to go out and just try to acquire all of these assets, why not partner with everybody that already owns all the assets, combine all those portfolios together and work them into something more institutional and bigger. And it's exactly the investment thesis for the SMI Legacy Fund. That's exactly what Logan's trying to do. Is we bring in a fourplex here, a 13 unit there, a 28 unit there. We move those pieces around. We do a refi. We sell a couple. We do a reverse exchange or an exchange, and he moves all the pieces around. And then, we go build a 70-unit apartment complex on OSU campus, or we go do something else. And the idea is to move up in. I think everybody's goal, no matter where you're at in your investment cycle, is the goal should be to upgrade your portfolio. The higher up you get, the less risk there is. You move up into newer assets, bigger assets, better markets, better locations, and you start to get into a realm where there's just it's a lot more stable and constant. It's like when you're running around picking up 10-unit value add projects, you might pick up 5 of them and 3 of them do really well and 2 of them cost you. It's like flipping houses. Some are going to win big. Some you're going to run into surprises. They're not going to rent as well. You're not going to get the rents that you were looking for. And others are going to outperform, like our 40 unit up in Astoria that we did. It's like, we thought that was awesome at our projections. And then we hit $300-$400 higher rents than what we were projecting. That's like a knock it out of the park type of a scenario. It's not going to happen every time. But I think that the ultimate goal, I mean, if you look, all you have to do is look at, the clients of mine that are the biggest players. They come to me and they're like, I want to buy 50 million plus, and I want something that's, no older than 5 or 10 years old. And I want only I-5 corridor. And if you're like more than a few miles off of I-5, they don't even look at it. It's like they're not stretching their buy box. They just have a very limited window. Now, they'll be the highest bidder on that property that they want. But as you move too far away from what the lane that they're trying to stay in, they'll just drop out of the deal. They're not even interested. But it's really more about the quality of the asset and the size. And I think size is a big part of quality we don't talk about. And when like Trevor was talking about a couple episodes ago, like he didn't realize how much better and easier in a lot of ways these bigger deals are, because it just opens up the door.
From a debt
you have people go like, it's like, we want to do this deal with you, and we can do it, if you're whether it's pref or it's debt or whatever it is, they're like, we want to do that deal, and they'll give you way better terms than we can get from anyone else, but they want to write a check for $25 million. And it's like, okay, well, we're in Oregon. So how many of those deals are there? Like if we were in California,
like
Florida, we're just not in that. We're in a market where there's much fewer of those institutional grade assets. So
and I think the biggest thing with starting the fund would be the idea that everybody should trade up into bigger stuff.
Well, you should probably have multiple funds over time. You should have funds that are targeting value add. You should have
Different
funds targeting new development, funds that are targeting, maybe different asset types, even if we go more into storage or we want to do MHP or something like that. So I don't know. I love the idea.
Well, the idea too is because we're creating unique offerings for every single one of these. And it's just like, here's the vehicle.
That's what I was going to say. You're simplifying it from the vehicle perspective. And so then it's okay, here's all of the deals that we do. They're all going to look a little bit different, but we're hitting the same returns on every deal. I mean, our goal is to hit the same returns to investors on every deal. And we're still incentivized to do the best
job
deals
possible.
We're still incentivized to do the best deals, because then we make the most, and we don't make the money that we want to make until that return is hit anyways.
So run me through just a real world example. Like we have an SMI broker who's got a few small plexes that he's selling right now, and he's going to 1031. He wants to do a project with us. In the fund scenario, we would suck his assets up into our portfolio in exchange for whatever shares he's going to get in future deals that we're buying or existing portfolio.
And he's actually what made me think of it, or
gave you the idea.
Yeah, part of what gave me
because there's a lot of people that want to do that. It's like, I own a few duplexes, but I got a bunch of equity. I own these things outright, but I'm not really making a bunch of cash flow. I'm not really getting a lot of depreciation. I know that I could turn this couple $1 million into equity into something that really builds for me over time.
Totally. And the issue is that with those people, a lot of times they don't have enough equity to hit the size of deal that we want to do.
So
they're right there.
So you got to put a few of them together.
But you have to put a few of them together, and then it's like you're pulling a Logan on the vicinity where it's like, okay, I have to do a 9-legged exchange.
That came to us a few years ago when we did that. It was such a crazy deal.
Yeah.
And we were like, just imagine if we didn't have to have, and Logan did all the work, but if he didn't have to have 500 phone calls to put the deal together. And he's like, if I just had control of this portfolio, I could have just moved the pieces around and it would have been 90% easier than what we did.
Oh, more, probably more than that. So that's the idea, is that you're saying, hey, here's the end goal. We both just need a better vehicle for it. Because I want to avoid the timing risk, and you want to avoid the headache of trying to coordinate all of it. And so then instead of saying, okay, I have to make sure that all 4 or 5 or 10 of this investor's properties all sell within the same period of time.
Yeah.
Instead, you're saying, hey, just give me control, and you have 10 people who are doing that. And if 10 of them, if we can sell 1 of 10 of each of their properties at the same time, then that's when we're going into the next project. And as a fund, you're allowed to hold the cash. And so instead of having to execute 1031s on all of those, it's like, no, we can just refi.
You don't have to 1030. Oh, because you refi.
Well,
their basis still has to be 1031.
Yeah, their basis
you can't land it in the fund. You'd still have to land it in an asset.
But you would just refi it and then sell it, and then you're not constrained on time.
Yeah, exactly. And so it's not that it gets rid of the need to do a 1031. It's that it simplifies the timing.
That's why we're doing reverses where, we refi or whatever, we have enough cash, we go do the deal that we find, and then we identify a few properties in reverse and go close on the deal we want to buy, and then we have 6 months to go sell, and it's like, okay, well, we need to sell 1 or 2 of these, so we put 3 or 4 on the market, hopefully at least 1 or 2 sell, and then you just get that cash back and not have to
the problem we have now is because it's so personalized, the timing is hard with the pieces, and it's like
and to us too, the hard part about the timing is that you're trying to time it for one specific deal that investor got excited about, and it's hard. Well, sorry.
Dane.
And it's hard to have to sell them on every deal every time one comes up. So if one goes away, then it's like, okay, you're selling them on a different deal instead of just selling them on the vehicle, because it's like, okay, it's the same deal. And to us, we recognize that it's the same deal. So you're not pitching a new deal. Yeah. It's like, yes, it's a different property, but it's the same deal.
What you're really talking about is control.
Yeah.
And you want investors and partners who come along. And I think that's what Logan's done a great job of, is just building that trust.
Yeah.
And also taking on only a certain type of investor or partner that understands what we're doing, so that they know, as you might bring in a few fourplexes, and we might decide the day after closing that you contributed, and the next day we might sell all of them or one of them, and decide what we want to do with that. But you trust that we're working the equity harder than you want to or can in your own portfolio.
Yeah. And the other side of it too is that I think from our lens or on our end as an operator, if you have that fund set up with the banking relationships that we have and the lending relationships that we have, I think once you have all of the equity across the portfolio, so you have all these people contribute these properties, now all of a sudden it's like, hey, we need a line of credit, and the line of credit is attached to us or the fund or the business itself, and the whole purpose of it is to eliminate the timing risk still. And it's, hey, we're going to use, some of the funds from this line of credit that you're giving us for the fund itself to close on properties. But no, it's always going to get paid down after this period of time, because we're selling all these properties. We just have to do 1031s, and we're closing on this property. But then it'll get the line will get paid down the moment that all of this is like 1031.
Yeah, we do.
So you're reverse exchanging.
Yeah, we'll do that.
Yeah.
You guys are just 2 steps behind Logan on this thought process.
Whoa.
But he's going to hate you when he listens to this episode. But yeah,
to have him to join us.
You bring on a private money, you bring on a, whatever.
Yeah.
I call him sugar daddy, sugar mama, whatever. You bring on a private money partner.
Sugar person.
Who goes, I'll give you $3 million. You can use it whenever you want. And we can kind of move the notes around, do whatever we need to do to make that work. And now you have not only your liquid capital, but you have the borrowing power to go do what you need to do and move the pieces around afterwards.
Yeah. Yeah.
So you like the idea?
Yeah, I'm already doing it.
But
you like the idea for us?
I don't know. We'll have to talk through it a little. Sure. I mean, I think.
Well, this is the time. You're committing or not? What questions do you have?
I've always liked the idea of having a fund. I think one of the things Logan and I talk about a lot is like, do we want to be the thinkers or the doers? You know, and so in the SMI fund management company, we want to move equities around. We don't necessarily want to do what Stack is doing out, identifying land, getting entitlements, building, doing heavy value. I like doing all of the dirty work. Like we know that Stack needs capital to do those jobs, and we'd rather go round up the assets, turn it into opportunities to invest capital with GPs like Stack or co-GP, and go with other players and go like, we're going to help you with the equity piece. You're going to we're going to find operators and developers and builders that we trust. You're going to do all the work, and we're just going to help you move the money around. And so I think that's one of the things that's different about Stack is the fact that we are launching multiple projects. We're building big, we're moving into a bigger phase where we're going to build bigger stuff, and we're always going to need that capital. And rather than trying to every single time we start over and go like, oh my God, we got to figure, who should we talk to go raise $10 million? It's
everybody.
Like, if you can systematize that in a way to where you already have the equity and the capital lined up, then that opens the door for you to go out and keep doing what you're doing and focus on finding the good deals and building the good deals rather than just constantly looking for partners to go do the deal.
And I think to that, I mean, he had like the vehicle's already created, and so it's just making another model, like, or not even making, but you have the chassis built, and so it's like, okay, how can we structure it in a way where he's equally incentivized, but then we're also super motivated to bring those people in, because right now we're not motivated to bring the people that we're finding that have these portfolios that want to trade. We're not incentivized to bring it in. And so we want to just say, hey.
You create an ecosystem. I've always said that at some point, like SMI Fund Management Stack are gonna come hand in hand.
Yeah.
And you roll those equities into a portfolio, turn it into cash, roll it back into a development. It's both companies can serve one another.
Yeah. No, and I think that's the biggest idea is just how do we create that?
I'm more excited about utilizing the machines we've already built than to build a whole nother machine.
Totally.
Because we already have it.
And we shouldn't have to.
And it was hard to build it.
That's what I was going to say. Is like, I just want Logan to build me another one. Like,
I don't know that you even need another one, but I think we need to sit down with Logan and talk about it. Yeah, I'm not. When I talk to Logan, I feel even dumber than I am. He's just the most.
He does that to me every time I talk
He's
to
the
him
most brilliant real estate mind I've ever met. It's insane how smart he is. But I'm excited for the future for all of us. Yeah. I think both companies can do great. And we've been trying to talk about, how do we not bump into each other and try to chase the same deals and do all. I mean, that's a problem I had.
I don't think we are. Like
he calls me a partnership whore, so he's always like, like a deal comes out and somebody gets 4 offers, and I'm somehow partners in all 4 of the entities that are buying it.
And you forgot that you signed on all of them?
I didn't. That's the best part about it is somebody else is signing on those, And I find out that we're offering, it's like, why is Gabe on every single one of these offers? It's like, well, you got to be kind of careful. I want to have, I want all the partnerships to somehow collaborate and work together and not bump into each other if we can.
Yeah.
That'd be good.
I agree. Trevor, how do you feel about it?
Trevor doesn't feel. He's a robot.
Trevor, what do you think?
It helps us do more deals.
Beep,
awesome.
bop, boop.
What think about this?
More deals equals good.
What's the bottleneck now? Is the bottleneck money? Is it deals? Is it like just trying to get through lending? Is it trying to get through?
I think it's
entitlements. Where is the friction right now?
The friction is on bandwidth of our ability to like get all these people to trade. Because Trevor and I both have sat down with so many people who have like 5, 10, 15 houses. And they're like, well, I'd like to do something with my houses. And it's like, I know that we can do something with all those houses, but I don't know if I have the energy. Or not even the energy, but it's like, if I chose to do it, that's the only person that I could think about for however long.
Think about you own just call it one asset, and you've got $1 million equity there, and you're like, hey, this thing's throwing me 3% return on equity.
Yeah.
I'm running out of depreciation schedule. I'd like to work this equity harder. Then you run through the whole thought process of, well, then I got to I got to go find a broker, and I got to deal with values, and I got to clean the property up, and I got to do showings. It's like, And then I got to go find an up leg, and then I got all this time. I got 45 days from the day of closing to go identify another I mean, it's not easy, and it adds a lot of stress to your life. Like half of your year is going to be spent
on that.
And
that's one.
And it's one deal, and you're like, and if you're not, I mean, think about this. Like we do this every day, all day long, and it stresses us out. Imagine if you're like running your own business or working a job.
Yeah.
And you got to do that also.
Yeah.
I mean, it's like a whole nother layer to your life.
Yeah.
And so when you think about like, oh, well, do I really want to work the equity hard? It's like, well, I'm thinking cash flows now. I don't care. I'll just wait a little while.
Yeah.
Until it maybe gets crazy. Once it goes to 2 million, then I'll be thinking about it, more or something. But I mean, I look at my portfolio and I'm like, yeah, I'd love to trade that one into something else. And I have the same thought process. It's like, I'd rather just put it into a fund and let somebody else go do all the hard work, and I'll just let them use my equity. But then you got to find people you trust, and you don't want to give away your whole, life savings to somebody who's going to go squander it.
Yeah, no, and that's totally the thing. Is that your goal is to be able to present one offering to somebody instead of, and that's been the issue. And Mark and I have talked about this a bunch. Is like on the fundraising side, at least. It's like every single deal that we do has a different offering. And then sometimes, actually pretty much every time, even on every deal that we're doing, that specific deal has like 3 offerings. Because we're offering something different to the person who's going to...
Well, different share class, and you come in early, you come in late.
Or you're the person bringing all the money, or you're the person only bringing half.
But isn't that how it's always going to be, kind of?
No, not with the... I mean, not with the fund model. That's the idea, is that like...
I think you kind of have to have both, though. I think you have to have... Like what we do in SMI Fund Management is we have the 721 fund, but we also do like single asset entities, single purpose entities, SPEs, where it's like this deal operates. The fund may participate in that deal, but then we also have some other share classes and other owners and stuff.
Yeah.
I would love to simplify, but I don't know if it's going to become as simple as you think it is.
Well, but the reason that he has to have the SPEs is because it's outside of the fund's buy box. And so if you could make it be, if you made a fund that was to
for
your
that
point,
buy box for
like,
value add.
Well, yeah, it's like we have a value add fund, we have a new construction fund, and then we have the SMI.
Well, then the purpose of this fund would be more for equity pop than bond like yield.
100%.
Yeah,
and there's 2 different avatars.
And it's funny because I have one of Jan's friends wants to put some money in with us, and she's not doesn't know anything about real estate, but she just knows she wants to own some, and it's like Jan's asking me, she's like, well, I said, first off, they have to be accredited. Well, what's that mean? Well, you got to have $1 million net worth outside of your personal residence. Oh, okay. Why? Well, because I don't want to go to jail. That's why. Yeah. So then it comes down to like, okay, well, how much do you want to place? Do you want it to be in 1 deal, 2 deals, 3 deals? And then are you looking for a check every month and a little bit of growth over time? Or are you like, I don't need a check, but I'd love to double my money over the next 5 years? Like that's a different investor, right?
Yeah.
And so then like the goal, when you think about the goals of the investor, what are their age, where are they at in their investment cycle, what's their real estate sophistication, like how much money do they want to place, how diversified do they want to be, and then ultimately are they looking for something slow and steady that just gives off a check every month, or do they want something that maybe isn't going to print a check for a few years, but we're going to get a big equity pop in 3 to 5 or whatever. And that's, to me, I think you kind of have to have all of that, because to try to come up with something where it's like a one size fits all, I'm not. There might
you won't.
You won't.
No, you won't find anyone.
But that's why you can have the 3 separate fund, and it's like, okay, if you're anywhere from 20 years old to 45 years old, you're probably really going to like the new construction fund. Yeah. You're probably really going to like our ground up fund. If you're 45 to 60, you might really like our value add fund. If you're 60 plus, you're probably really going to like our bond like yield fund.
Well, I think you can do value add and new construction the same thing too.
Yeah, and I'm not saying you can't.
You know what's interesting? There are people that are 30 that are further along in their real estate 100%. Investment cycle than people in 60. So it's not always just age.
And that was a broad brush.
Yeah.
But the idea is just that like there's a specific avatar, and it's not age based. It really is portfolio based. But there's a specific avatar for each fund. or for each deal type rather. And then if you can simplify the offering to that avatar so that they don't have to think about it, and you're offering something specific as a fund, but you're pitching one thing instead of saying every deal is different. This one might be a home run, this one might be. It makes it so that on that fund, you're going to average triples.
Then the next problem you run into, and I see this with some of the big offices that are doing like, oh, we did $1 billion on a value add fund. And then they thought, they'd set this up 3 or 4 years ago, and then they weren't able to buy anything for 2 years, and they end up sending the money back because they couldn't do any deals, or they had to just shut it down because they couldn't actually go out and transact. So you have to know that you can fill the pipeline consistently.
But and I think to that point too, we're not doing it in that order. In the sense that like all those guys
raise all the money first.
They're good at raising money. Yeah, it just scales naturally in the sense of like, okay, as we get to the point where we know we can start doing X number of deals at this size, that's when we start.
What you're really doing, you're just giving us control of your portfolio so that we can go at it with ours and others. Yeah. And we can all put it together and we can go turn it into something bigger. It's totally Logan's complete investment thesis.
It's the exact thing. And the other side of it that's huge.
You did not come up with this.
No, I don't think that I did. That's why I said Logan should do it with us. But the other side that's huge is that, but we have to be committed to it. And we weren't on the front end of like, well, we don't want to play it like that and here's why. Yeah. But the other side that's huge is that then on single assets that you're trading around, you're so much less concerned about taking a 5 or 10% haircut. Whereas when an individual person is selling their portfolio,
they want all the money.
If somebody's like, if they listed it at $500K and somebody offers them $460K, it's like, I'm not going to take a 10% or an 8% haircut.
We've brought deals in where we end up selling them for a little less than the appraised value they got credit for. Yeah. Because we know the money's going into another deal that's 10 times better than that deal. Yeah. And it's like, we took a little bit of a loss on what we let them contribute in at, but we're going into a deal that's so much better for them and all our investors. Yeah. So they got a few more shares.
Doesn't matter.
But it doesn't matter because we're going into something much better.
And within your fund, that's my fund, you don't get to own the real estate, right? You just get to promote a profit share.
Who are you talking about? The investor or me?
No, you. Yeah.
We'd take a promote.
Yeah. So, but you don't get depreciation from that.
Yeah, and I own shares. I mean, we're contributing our own real estate, and that's how we launched the fund. Is with us and our close partners. We put all of our. That was one of the things that's hard to make something like this start is we had to have a big enough portfolio to invite people into. And so we had to pull together assets that we basically had already gone out and partnered with a bunch of people, bought a bunch of stuff, and we had something to work with as ground zero. If you were starting from zero, it'd be like, we'd like to invite you in and you give us your property, and then guess what? You get to own your property. Yeah. It's like, that doesn't really work.
No, and I mean, I think it would put us in the position where we would figure out which assets we wanted to trade and get out of and why. And I mean, maybe not even but just like
what it does is it makes every asset on your SREO become trading stock.
Yeah.
And now you're not a Paul Curley where you're an asset collector. You actually truly become an equity trader, and it's less about each individual building, and it's more about it's just taking the money out of the slow horse and putting it into the fast horse. Yeah. That's all it is. And you're just constantly looking for the slow horse to pull the money out of, and you're constantly looking for the fast horse to place the money into.
Yeah. No, and that's why you can sell at a discount. And it's not even really, because it's like, okay, if I can go and triple the money that I'm about to put into this thing, it's okay if I sell it at 5 or 10% discount. It doesn't matter. The market's super
We look at that in our own portfolio too, where we go like, well, should we sell this thing? Like we could have sold it for $500,000 more 6 months ago. And it's like, well, yeah, it makes you sad that you didn't sell it 6 months ago, but you didn't. So that's just the reality. And then you line it up and you do a benefits analysis. And, Logan taught me this too, but you just look at the 4 economic benefits. You've got your cash flow, you got your principal buy down, you have your appreciation, you have your depreciation. It's just 4 numbers. You calculate it on your asset you already own, you calculate it on the one you're going to buy, and you just look at all 4 numbers and you go, does this make sense to move it from there to there?
That one's better.
Now you're not thinking about like, oh, we could have sold it for more a year ago. It's like, it makes sense for us. He talks about the loaf of bread. Sometimes you got to you got to slice the loaf down a little further on one side that you didn't want to because you're picking it up on the other side of the loaf.
Yeah.
It's not how bread works.
Oh, man.
All right.
All right. Well, that was fun. I don't know if anybody's going to get anything out of that, but you can listen to us.
Join our fund.
You can listen to us talk
Starts
about
in
things,
27.
real estate things. All right, you guys want to wrap it up?
Yeah.
Okay, hey, Deal Junkies, we love you guys. If you want to have a call with us, probably Trevor or Dane or me, I guess. Nobody's put me on the phone call yet, but you want to have a 15, 30-minute call, go to dealjunkiespodcast.com. You can book a free call with us. We want to talk to you. Maybe you want to join us on a deal. Maybe you got a deal you just want to talk about. We would love to talk to you, give you some free advice. Please share us with someone you love, and we'll see you next time.